Yeah.
Ooh. Yes. I'm stressed, yes. And then still feeling kind of like out of it. I don't even know what I'm doing, where am I? Here with the photos. Oh my God, that's me neither, it's fine. I still feel it. My forehead
Now, you're one popular person.
Oh.
Welcome back.
Thank you. It feels like forever. I left because my mom was not doing good. She's in Arizona and I went to go take care of her. And
Understood. Yeah, I got
it feels like it's been gone forever.
Family's a priority.
Yeah, always.
70 pounds there. Oh, I supposed to be
It means good food over there, right?
Yeah, too much.
Oh. Right.
Any news? I know Harsh just posted anything else?
So I
Meeting on time,
cannot
right.
find the but, we didn't find any house.
We'll send this to the
I heard congratulations, seems like, the open house was wrong. And,
Nanook or the client?
no, client.
But I came at 9 today because I wanted to pick with them. So I sent all these photos yesterday after the weekend. At least like I sent that one and we had it around
Here?
अच्छा आपसे इंफॉर्मेशन मिला है 8 to 8 आई थिंक मैंने अभी टैली ली थी 8 लोग हैं there was one agent who was looking forward to getting more information. Other than that, 2 or 3 people did not like it. 2 or 3 people had their agents. One Desi had come. Only one Desi. It was a nice house. I have seen some.
I am guessing they are selecting mature because they know.
Actually, कितना per year, right?
Because we're all there, it's like, Mom, we gotta get this out. Everybody died.
Yeah.
So usually I think everybody had a good law.
Yeah.
So maybe they were in
Yeah, go ahead.
बहुत अच्छा लगा. Oh, backyard was amazing.
Yeah, no problem, anytime. Let me know if you need anything else. Look who's back.
It's good to be back. Oh, I've been better. My mom's still okay, but I'm like at least some normalcy a little bit. I still feel out of it.
Well, hopefully we can make you feel a little bit.
Yes, no, you did. The girls already made me cry. Harsh, and I'm like, Harsh did it. He was like, hey, Sophia.
Harsh making people cry.
He was like, Cynthia.
Your profile picture is so nice on WhatsApp. Really like.
You told me that you
Yeah, I told you
Yes.
yesterday. I thought, yeah, this would be.
Okay, 10 or 2.
How much maybe to.
I'm assuming the first one is ready, so you will. Yeah, we can come and cook tomorrow.
Oh, really? My kids go back up on, like, they come in Monday, but at least I'm gonna look at least.
He's fine. He won't be here tomorrow.
He said, yes, he said he was gonna go to that.
Oh, I didn't check that in my.
मैंने देखा नहीं.
I got about 2/3 of you.
Not too bad. Everyone have the handout?
Are we recording this session, Steve? No? Okay.
Hmm? I didn't want them to know that. Okay, that's fine.
People.
You were here this weekend.
Right. You might use the difficult part.
I'm really new in here.
All right, why don't we get started? It's 10:05. I gave you 5 minutes.
To settle down.
Well, I don't know. I guess oh wait, Bamal's coming. Are you coming in here?
Yep, I'm there.
You didn't wait till 11 after, all right.
Yeah, I was waiting for 5 more minutes to go.
Wait, yeah, right, okay. Well, welcome. I think everyone, just about everyone knows who I am. For those of you that don't know who I am, my name's Steve Pierce. I am one of the original founding owners of this market center, as well as the Pleasanton Market Center. At one time, I was a broker for 6 market centers with about 900 agents. It was like trying to nail Jello to the wall. It was a crazy experience. I've been in the real estate business for almost 36 years, and I've been an attorney for almost 43 years. And I took a lot of tax courses in law school, and I almost considered going another year to get a master's of law degree in taxation, but because I didn't have an accounting degree, probably was going to be a little challenging. But I did take a lot of tax law, more than the average law student. So that's why it's been kind of a passion of mine, and I've tried to stay on top of it. But the tax laws just changed so significantly, especially in the estate planning arena. But I try to stay on top of it with respect to tax laws that related to our business. And you may not realize, but there are a lot of different tax laws that we deal with in our business. And the one thing up front is the purpose of this course is to not make you tax experts. It's not to allow you to give tax advice. There's 2 things. One is there are some aspects of taxes that we do day in and day out in our business. And so there are some of these things that you do need to know if you're going to prepare a net sheet for a seller. Now, some of these programs will automatically do some of the calculating for you, but you need to know what numbers to put in a seller's net sheet or a buyer's estimated costs. So you need to know some of the taxes that we're going to talk about. You do need to know them in order to really do your job. But the other thing is there are certain aspects of this that you need to familiarize yourself with the taxes and the tax consequences, because there will be situations where you really need to make sure your client, quite often the seller, consults with a tax advisor early on in the process to understand what their tax consequences are going to be from the sale. because a lot of people don't understand how it all works. And so it's really important. And the more you know it, the more you can address the issue even on your own. And you're not trying to give them any kind of exact numbers or anything like that, but you want to recognize the issue. I'll give you a quick example. Back about maybe 10 years ago, market was really hot. Neighbor down the street calls me. Known her and her family for years and years and years, and her husband passed away years ago, and she wants to sell her property. She has a unique property, sits on 2 acres, and at that time, the property was worth about $3 million, and the market was hot. And she called me up and said, "Steve," she goes, "I think I want to sell the property." So we talked some more, and why do you want to sell it? She didn't really need the money. She just thought it was a good time to sell. And I said, "Well, okay, and what are you going to do with the net proceeds?" Well, she hadn't even really thought what she was going to do with that. Now, this was principal residence, so wasn't eligible for a 1031 exchange. And so while I'm on the phone with her, I do some quick calculations. And I said, "Well, Josie, you realize that at $3 million, you're going to have a tax bill of about $750,000. So out of that $3 million, after paying commissions and taxes, you're going to end up with maybe closer to $2 million." She had no idea. And as a result of the advice I was able to give her without even having to have her go to a tax preparer, she decided it doesn't make sense for me to sell. I'm still living in the house. I'll leave it to my kids. Does anybody know what happens when the kids inherit the property?
Property
They
taxes
get-
don't increase.
No, that's the small issue. The kids get a stepped up basis to the value at date of death, which means they can turn around and sell the property the very next day, and they're actually going to sell it for a loss because you deduct the commissions and closing costs from the price before calculating whether there's a gain or a loss. So it didn't make any sense for her to sell and incur that. Now, if I hadn't known how to do that, the first thing I would have done before even listing the property is I would have told her, you need to talk to your CPA or tax preparer, and then let them be the bearer of, bad news as far as what the tax consequences are. So there's an example where having a rough idea, you can kind of cut to the chase, so to speak. So that's just an FYI there. Another issue, and we're going to go into a lot of this in detail. Some of these things I'm just glossing over some of these points, but I just want to give you some real-world examples. Another example I have it going on right now is investment property, rental properties, and whether or not there's actually going to be a taxable gain on the sale of the property, a gain or loss, depending upon the seller's basis in the property as a result of the death and the sale now. I have a property that's closing tomorrow where I've done a broker price opinion as to the value of the property on the date of husband's death in 2022, and that value is higher than what I'm selling it for today. Now, on paper, that suggests, if you stop there, that suggests that she's going to sell it for a loss. And if she's going to sell it for a loss, there's no state tax withholding, okay? But you don't stop there. With an investment property, if the taxpayer has been taking a depreciation deduction on the property, and on residential property, you can take depreciation over 27.5 years. When you sell the property, you recapture all that depreciation by reducing the basis in the property, which creates gain subject to tax. And so you go from what looks like a loss situation to a gain, and the tax rate's different for the recapture. It's up to 25% versus federal for most people is 15% or at most 20%. So there's actually different tax rates involved. But my point is that's another example where you really you really have to make sure that when you know your client may have some tax consequences, you need to make sure that someone is there at the wheel addressing it. Their tax preparer, their CPA, so you need to bring them on early on, especially once you determine what the purchase price is. So again, I'm just giving you some real world examples of why it pays to know some of this, so that you're just not letting the seller go off and meet with the escrow officer and go through the whole process, and then, because in the situation I have now, at 3 1/3%, the amount that was going to be withheld and sent to the Franchise Tax Board was going to be just over $53,000. Now, I've been talking to the CPA in Hawaii, and I'm waiting for them to get back to me to confirm how much potential tax liability she's actually going to have. Is it going to be above, below, or close to the 53? Right now, we think it's going to be close to that same amount, so we'll probably just let it ride. But by letting that be withheld, the Franchise Tax Board has that money to use interest-free, and if there's any money that's due back in a refund, it's not going to happen till next year, within a month or so after filing a tax return, which is not going to happen probably any sooner than February or March of next year. Okay? Again, you guys are all looking at me like you're scared, okay? And we're going to go. We're going to touch a lot. We're going to go into all these different things in more detail, but I'm just giving you some examples of why you need to learn what you're learning, so that I want you to be familiar with it, to understand and spot the issues and address the issues. Okay, does that make sense? I'm not trying to make you know what I know and be able to do what I do. I want you to go into it, when you go into a transaction with eyes wide open, and understand where the landmines might be, okay? Because the last thing you want to do, and I've seen agents on the other side that they don't have a clue what's going on with the tax consequences of their seller's listing. Not a clue. Particularly when it comes to investment properties. Because if you've heard of a 1031 exchange, the 1031 exchange is a method that allows you to defer taxes on the sale of a property. And you certainly don't want to even bring up the 1031 exchange when you're consulting with a seller of investment property. Because if you don't bring it up and escrow closes, it's too late to do anything at that point. Does that make sense? Yeah, so again, these are all reasons why you need to know this stuff. But I'm not expecting you to be a tax expert, be able to give tax advice. But there are several things here that there are the things that you are expected to know are pretty much just straight line calculations based on purchase price and that sort of thing. Okay, they don't deal with people's actual tax returns, filing taxes, and so forth. Okay. Now this is a property tax calendar. I tend to like to look at it a little differently. Property taxes are a little unusual because in the state of California, we don't use the calendar year for property taxes, okay? We use, our tax year runs from July 1st through June 30th. Instead of January 1 to December 31st. And I've never looked into, the whys and the wherefores and why it's done that way, but that's how it's done in California. So you have 2 tax periods. Now, before I go on, how many people in the room are homeowners? Well, a good percentage of you, okay. So you all pay property taxes. Now, you may not be that involved in what they are and how they're calculated, but you're familiar with that, and you're familiar with filing tax returns. So basically, property taxes, you have 2 installments. The first installment is due November 1st and is late after December 10th, okay? And the second installment's due February 1st and is late after April 10th, 5 days before the next big tax due date, April 15th, for your income tax returns. So basically, this is when taxes are due. We'll talk about prorations in a minute, but just because we have this calendar here, I just wanted to show you this is what the year looks like. It's not January to December, okay? Now, if you look at your outline, don't look at that. Okay, as most of you know or should know, within the industry, when it comes to estimating property taxes and what lenders use when they do a loan pre-approval, we use 1.25% of the purchase price as the estimated or approximate property taxes. That's the standard for lenders. Anybody, if you're using any kind of apps that figure out principal, interest, tax, and insurance, they should be pre-programmed. If they're not, program it so that the property taxes are 1.25% of the purchase price, okay? Now, property taxes are made of 2 components. One's called an ad valorem valuation, which starts out at 1% and then has, due to certain bonds, measures, and whatnot that are passed, the ad valorem portion of property taxes can get up over 1%. And then you have what are called special fees assessments, which are fixed dollar amounts. If you flip in your handout, go 5 pages into the outline, you'll see 3 tax bills. Not the big handout, the small one, the handout, the outline. And and you'll see there's 3 tax bills there. One for Fremont, one for Newark, and one for Union City. If you look in the left-hand column, you'll see the ad valorem tax rate. So in Fremont, and this is actually my property tax bill. So if you look at you see the tax rate starts out at 1%, and then you've got City of Fremont, schools, BART, East Bay Regional. You've got all these little rates that get added on, and the rate's 1.1327. Everybody see that?
Yeah.
But then you go over up to the right-hand column in the upper corner, and you've got all these fixed charges or special assessments for sewer, mosquito, paramedics, okay, mosquito abatement, East Bay Trail District. You have all these fixed dollar amounts, so those amount to another, in this case, $823.08. When you add those 2 together, you see where I've handwritten in and below there, the effective rate for Fremont, at least based on my tax bill, is 1.245%, almost exactly 1.25. Flip one next page over, you got Newark. Newark's just based on this bill is slightly lower, 1.219. Now I've looked at multiple bills at times, and I typically see pretty much the same thing per city. Go to Union City. Union City's just a little higher. Union City's got more fixed charges. And their rate on this particular home, 1.312. So my point is, we use 1 1/4, but it's not exactly 1 1/4, depending on which city the property's in. And then we have another thing which is called Mello-Roos, which we'll talk about in a minute. Now, Mello-Roos is added to a tax bill, and that can run it up, that can drive the effective rate up to 1.5 to 1.75. Yeah, we've got a community in San Ramon, I think they're up to 1.8, something like that. Okay, so it's a much higher number. So again, so you when you're working in an area where you know it's a higher rate, you need to be familiar with that. The 1 1/4's, it's going to be like surprise to your seller, or your buyer rather, when they find out, oh, it's not 1 1/4. This is much higher. Now, the quickest. Now, I understand you can go online. You can go online and look up property tax bills for anybody, as long as you have their address. Okay? And you'll notice on the tax bill, the owner's name doesn't show up on the bill, but we know who the owners are because we have access to the tax records on the MLS. So you could look up anybody. I wonder who put their tax bill. You can look up anybody's tax bill. It's all public record. Now, the other way you can determine how much the taxes are. Now, one way to determine how much the taxes are, at least how much seller's taxes are, is from the preliminary title report. Everyone notice how you get about 3 or 4 pages in and you see the tax amount that shows whether it's paid or not. But remember, all you're seeing is, you're not seeing the assessed value. You're just seeing how much the seller's taxes are. Now that's relevant when it comes to tax prorations when you're closing escrow. But that doesn't tell you what the rate is. You've got to look at the actual bill to do the calculation. Does that make sense? You understand what I'm talking about? Like I said, in most cases, it's going to be, like I said, if you're in Fremont, New York City, you really don't have to worry about it because they're all very close to 125. But you get into other areas, you may, if you don't know, you may want to check to see, what is the rate, especially when you've got Mello-Roos. Now, for the longest time, Fremont, we didn't have, the only Mello-Roos we had in the whole Tri-City area was in Union City. We had one development on the right-hand side, when you go, leave Niles, cross over Bart, on the right-hand side. That was the only Mello-Roos development in the whole Tri-City area for years and years and years. And then Warm Springs Bart came along, and they flooded Warm Springs with townhouses, and they're all on Mello-Roos. Okay? So we do have them there. The most common Mello-Roos is out in the valley, out in Central Valley. Okay? We'll talk about that in a minute, but I'm just bringing that up because you're looking at talking about tax bills and tax bill rates. Now, we say that it's 1 1/4% of fair market value. Prop 13 assumes the purchase price is fair market value. What's that mean? That means when the assessor gets the grant deed and sees the price that the property was sold for, they're gonna look at it and analyze it to determine, is this price reasonably related to fair market value? And if it is, they will accept the purchase price as fair market value. But if they believe that the value of the property is higher than the purchase price, they can assess it higher at what they deem to be fair market value. Now, there's a couple scenarios where that can play out. One is the agents try to manipulate the price by having the commissions paid outside of the purchase price. Take it outside of the deal so that the price is lower, doesn't reflect the commissions, in hopes that it'll fly through. Now, it's interesting because now with buyer broker compensation, we've got deals with commissions being paid outside. Now, on the preliminary change of ownership report, which we'll talk about in a little bit, there is a line there. Remember, the preliminary change of ownership report is completed by the buyer, and there's a line there that asks, were there any commissions paid outside of the transaction? Well, guess what? I researched about 3 different deals after the new rules went in to play, and I researched like 3 different transactions where I knew my commission and some of even sellers had been paid direct by the buyer, not part of the price. And I wondered how was it processed? Well, I discovered in all 3 of them, that line was blank on the preliminary change of ownership report, telling the assessor that there was monies paid outside of the purchase price. And then I brought it up to my escrow officer. I said, hey, did you realize that, with the new buyer brokerage compensation and buyers potentially paying commission, not coming out of, not by the seller, that you need to be putting that broker compensation on the P Corp? It was like, whoa, revelation. Didn't even occur to her that, and that's pretty much with it. Now, I don't know if it's becoming more commonplace or not, but that, just understand that's an issue. I mean, I had one transaction where my buyer paid my commission and about $45,000 of the seller's commission to lower the price. So they paid over $100,000 in commission as a buyer closing cost to lower the price in hopes of having lower property taxes. The last time I checked, as I recall, I think it went through. So it wasn't, so that $100,000 difference didn't move the needle as far as the assessor was concerned. But it is something to be aware of. And like I said, I think the industry's still trying to learn its way through, especially on the title side of it. Because my escrow officer was like, wasn't that she knew the line was there, but they just never used it. And I said, you really should be putting that in there. Now, another example, off-market sales. I was involved in an off-market sale. We had offered the property to a tenant. After giving the tenant plenty of time to figure if he could come up with a down payment and whatnot, offered him, I did a market analysis and I came up with a number, and the seller/landlord agreed to offer it to the tenant. Tenant couldn't go through with the deal. Well, at the time, I happened to have a client in escrow with a 1031 exchange, and about his net proceeds from the sale were about $35,000 less than the price of the property. So for him to buy the property, he was going to have to come out of pocket with another $35,000 of new money on top of what he was netting from the sale of the rental property. And he went ahead and did it. 6 months later, supplemental tax bill comes out. Property was assessed $125,000 higher than the purchase price. So he shows me the bill, and I look at it, and I said, I've got good news and I've got bad news. Now, because you could appeal the assessment. I said, you can appeal this if you want, and I'll help you work up the comps, and we'll go fight the county assessor's office if you want to do it. He goes, nah, he goes, I don't worry about it. I said, the bad news is you're paying a little bit more in property taxes than you thought you were going to pay. The good news, you got a good deal on the property. He actually, in the eyes of the assessor, he was able to buy the property at $125,000 below fair market value, and he was fine. mean, do the math. We're talking about $1,400 more in taxes a year. Don't think it's gonna change his life much, okay? But again, I'm just giving you some examples of this purchase price. You know, purchase price is assumed to be fair market value. What people don't, when you read Prop 13, it says fair market value. So you never want to tell your buyer, especially if you think maybe they're getting a good deal and the price maybe is a little lower than what the comp suggests it's worth. Don't make them think that this is etched in stone, that your taxes are going to be exactly based on purchase price. Make sense? Now, under Prop 13, before Prop 13, California counties taxed property based on fair market value. So every year, they would reassess the property, determine what the value of it is, and the tax would be based on value. And as properties got up, taxes got higher, and a lot of people in the state of California simply could not afford the high property taxes because of the high values of properties. So that's when Proposition 13 was passed in 1978, and it rolled back values to what was on the 76 tax roll. My memory serves me right. And what Prop 13 says is that the county cannot increase the assessed value on an annual basis more than 2%. So if you get your tax bill, and every year you get a notice that says, here's the value. Now, sometimes that value is going to, if you do the math, if you saved it from before, you look at the old price, the old value, multiply it times 1.02, and that's going to be your new price, if cost of living has gone up over 2%. Now, for a long time, we never experienced any increases less than 2%. Then, with some fluctuations to 08, 09, 2010, values went down. We saw taxes only going up maybe 1% or so. It's been the last time I checked, given over the life of Prop 13, I think we've had between 7 and 10 times where it's been less than 2%. More often than not, it is 2%. But we're talking about the assessed value. So again, you do the math. The increase in property taxes is a pretty small amount. Get your calculators out. Everybody, get your calculator out. Get your phone, your calculator. You need to know how to use your phone calculator. You should be wearing out that app. Okay. Assume a $2 million assessed value today. The taxes, if they increase the assessed value by 2%, what's the new assessed value?
2040.
What is it?
2040.
$2,040,000. So the value went up 40,000. So what's 1.25% of 40,000?
25,000.
How much?
25,000.
2,000?
25,500.
25,000. No. $2,550. Okay, here's how you do the math, folks. You go 40,000 times 0.0125.
Wait,
On the
are we doing, how are we, what's the math?
I want the tax on the 40,000, not on the 2,040,000.
500,000.
500.
Okay, $40,000 times 0.0125.
Yeah, 500.
$500.
I was doing around 2 million.
Okay, do you understand what we just determined?
Yeah.
We determined the increase in the amount of the property tax bill from one year to the next based on a 2% increase in assessed value. I don't want to go any further unless you all understand that calculation.
So,
The assessed value was 2 million. And the maximum increase is 2%, so you take 2 million times 1.02, and that difference, the amount that the taxes increased, was 1.25% of $40,000. Got it?
Wait, so are we multiplying it with the assessed value, which is 2 million?
No. I'm just calculating the increase. How much did the
Increase,
taxes
okay.
go up? That's what your client wants to know. How much are my taxes gonna go up?
So it's
So,
two things. It's
let's
two
just
things.
take, let's use another price.
Yes,
Let's say,
It's two things. The assessed value went up $40,000.
$900.
but they're,
But the taxes didn't.
40,000
they
They
only
were
go up
a
one and a
fraction
quarter
of that.
percent of that 40,000. So who's had a recent closing for a buyer? What was the purchase price?
$875.
$875. So everybody do the calculation. What's the taxes on $875?
$875?
$875,000. What's the taxes? You guys are taking too long.
218.75.
Ah, okay.
How much?
218.75.
$218? No.
$10,937.
Okay, let's stop a second.
$10,937.
What is it? 10,937?
0.5.
.50. Okay. So John's buyers taxes for 1 year at 1.25% at $875 is $10,937. Are we all in agreement?
Yes.
I want everybody to come up with the same number. If we're not coming up with the same number, you're not doing something right here. All right, now,
Why 2%?
Because we get the.
Year
the
2.
2%, we got 2.2.
the county reassesses the property at 2% higher, because the we'll assume cost of living inflation's gone up over 2%, and they're gonna increase it by 2%. So what's the new assessed value?
892,500.
892,500? Okay. And what are the taxes?
$218.75.
Okay, you're doing the difference already. Okay, so the difference, what was it, 218?
0.75.
Okay, do the 892.5 at 1.25, just so we can see that number. What is it? 11 something.
11,156.
11,156.
25.
See that, when the issue of taxes come up, you don't assume the client knows how to do the calculation. You could have the brainiest engineer in the room and not know a darn thing about how to use a calculator and do that calculation. I've seen it over and over and over again. Okay? This is the number that counts. Yes, your assessed value is going to go up, could go up as much as 2%, and your taxes will go from 1097 to 11,156, which means your tax bill is going to increase by $218.75. That's the number they need to know. Make sense? Bless you.
Bless you.
Any questions? You guys know the numbers? Price times 1.02, assessed value 0.0125%. Or you can go 1.25 and hit the percent sign, whichever you prefer to do, whichever your fingers are programmed to do.
Okay, multiply 2.
Moving on. So everybody understands how that works. Okay, we have various exclusions from reassessment. There's a lot of stuff in here. It's reading material for you to read when you can't get to sleep. Okay? Or you got a slow open house. How's that? I get a lot of reading done. All right. Actually, I made these all up in an open house.
Wow. Amazing.
Okay. This is what we call the preliminary change of ownership report, or the acronym is PCOR. you hear anybody that's talking real fast and we refer to the P-Core, that's the document we're talking about. That's the document that it's in your packet. This is the document that at closing, at the sign-off, the buyer completes this document, not the seller. Now, the escrow officer will fill out some of it, but not all of it. There's a few things, some of that right at the top here, you've got, it's asking, yes or no, is this property intended as my principal residence? And if so, when do you intend to occupy it? Because they want to know, is it going to be owner occupied or is it going to be non-owner occupied? Because there's other ramifications with when it comes to the transfer of the assessed value, particularly if it's a transaction between a parent and child. And that's why they want to know, is it going to be occupied as principal residence? Some of the most common typically in a normal buyer to seller transaction, there will be none of those boxes in part 1 will be checked. Because you've got a seller and a totally unrelated buyer, and there's a transfer of property. So it's subject to reassessment. There's no exclusion there. Most of these exclusions deal with transfers between spouses, and one of the more common ones is transfers to a trust. There's no reassessment when owners transfer their property to a trust. It's excluded.
Steve?
Now, somebody have a question? Yeah.
Is this only for the reassessment? Is this only?
This document has to accompany the grant deed. Any grant deed, any transfer of any interest in property, even an affidavit of death has to have this accompany it. Anything that's going to be submitted to the recorder's office, it's going to be recorded on the title of the property, has to have a P-Core accompany it. Okay, so even as simple as an affidavit of death of a joint tenant or of a trustee, you've got to record a P-Core with it. You've got to tell the county what's going on here, because they need to know, is it a change of ownership triggering reassessment or not?
Right, and my question is around that, which is this only with the reassessment, or rather no reassessment of Bradley happen only for primary residences?
No. This is all property. This is all property.
There's no number of properties or anything?
No, it has nothing to do with, no. Any deed on any property has to have a preliminary change of ownership report submitted. Because on page 2, and you look at, it has transfer information. What's the date of transfer other than recording? Is it a purchase? Is it a foreclosure? Is it a gift? Even gifts. Even when you got a parent giving a property to a child, you still have to file this document and show it's a gift. Then it asks for details on the purchase price in terms of sale. Now, typically what happens is part 3, the escrow officer fills out. The buyer isn't expected to fill. The escrow officer typically fills out. Basically, the escrow officer will typically not fill out the 2 yes/no questions at top about intention and the address for sending tax bill. They'll fill out part 1 because typically it's just no to everything. They'll fill out part 2. They'll fill out part 3. If you look at part 3, 3F is what I was referring to earlier. Amount, if any, of real estate commission fees paid by the buyer which are not included in the purchase price. That goes on a lot now. I won't use the word a lot. From August 12th to the date that I did this was like January or February, I can't remember what. what month it was exactly. We had closed like 38 buy sides. And out of 38 buy sides, only 3 of them had a buyer paying their buyer's broker commission outside.
10%.
And they were all my transactions. But yeah, it was like 3 out of 38. So it's not happening a lot, but it is happening more and more. And escrow officers should be filling that box out to let the assessor know. Now if the more commonplace it becomes, that means most of our comparable sales are not gonna include buyer's broker commission, so there'll be a new benchmark for where value is. In the meantime, if you're really fine tuning an assessment, an appraisal of a property, you may have to factor that in. I mean, generally speaking, if you've got, assume this, at least before August 12th of last year, every closed sale, for the most part, assume it had a 5 to 6% commission paid by the seller in that price. Well, if you have you negotiate a deal with no commission paid by the seller, and you have a naturally lower price, in order to have an apples to apples comparison, you have to bump that price up by 5 or 6%. So it's on par. Does that make sense? Mm-hmm. So we do that a lot in buyouts between siblings or heirs. You've got to you've got to figure out, you got to allow for commissions in there, either to be added in or taken out, so that you're comparing apples to apples. Okay. Part 4, property information. Again, typically the escrow officer does not always fill this out because they don't know all the detail. Now here's the one question that you need to be mindful of is 4E, because it asks about the condition of the property at the time of sale. Was it good, average, fair, or poor? And then it says, please describe. Well, typically you can I fill these things out all the time. Okay, I do estate planning, so I'm always preparing trust transfer deeds, and I always have to do this. And I'll just check a box for the condition, but I won't describe, I won't put in, they never ask for anything further. But understand, you may have a situation sometimes where you want to support the value, or you may want to support a lower value. I'd be careful trying to support a higher value, but you may have a situation where you've got a property that's in such bad condition, and you're selling at a low price, and you're trying to establish a low price for the property. You want to load up. You're going to want to attach every bad inspection report and anything you can find. It's the exact opposite of what we do in appraisal. With appraisals, we want to give them all the positive stuff to support the price. I mean, I had a deal where, not to belabor the point, but it's happened to me. I'm on my second property with this situation. I've got a multiple parcel property. I've got one on a Williamson Act contract, which has very low taxes, and I've got one with normal taxes. Well, when you negotiate a deal like that, you've got to negotiate a global price on the total property, and then you've got to prorate the price between the two parcels, because you got to put a fair market price on the non-Williamson Act property, because the Williamson Act's not going to get reassessed. So you got to separate the two. Well, I tell the agents, I tell the buyers, once the seller just cares about the global price. They don't care how you divide it up between the two. So, if I'm counseling a buyer, say we need to sit down and come up with the lowest possible price for the house that's not on the Williamson Act contract that we think the assessor will accept as fair market value. Now, worst case scenario is if they think it's a little higher, well, then they like I told you earlier, they could put it higher. But when you're trying to knock the value down and support a low value, that's where all the negative inspection reports come in. because you want to sell them. Yeah, we only put this price on it because here's the condition of the property. I mean, I had a property, one in question on Palomares Road. I had $176,000 Section 1 repair estimate.
Whoa.
Okay? You think that's going to support a low price on that house? Better believe it. That's what I told the buyer's agent. I said, you need to. Well, they didn't go in as aggressive as I would have. I would have gone in more aggressive, but they didn't. And part of it had to do with financing and how much they had available, because they were going to have to both deals had to be separate escrows, separate financing, and vacant land is harder to finance than. It's different financing than that. Anyway, I'm just throwing out reasons why sometimes you may want to put down that a property's in poor condition because you're trying to support a low price, and then give them as much information as you can to show them how bad this property is. How many people in here have ever received a call from the assessor's office? Atita? I have more than once. Because what they'll do is they'll see a comp, they'll see something I've sold, and it's unusual, and they want to know, tell us how you came up with that. What did you do? Sometimes the answer isn't all there, off the MLS, and so they'll call up the listing agent and want to find out. Tell us about they want to know the history of the transaction. How did you arrive at that number, and so forth. All right.
Steve, you mentioned there are two exclusions, right? Transfer between spouses and between trust. What about gifts? Gifts to the offsprings, to the kids.
Okay, it depends on what we're going to talk about in a little bit when we get to Prop 19. Okay.
So do you just give escrow your, like, say you want to get the price down, you just give them your whole inspection report?
Yeah,
you
would.
just
Yeah,
write
and
in
I would bet you at lunch that your escrow officer's never had that happen.
And
What are you doing? I go, you can. The P-Corps says you can add information to the P-Corps to get to the assessor.
So you write C reports for.
Yeah, and make copies of everything. The exclusions I gave you are from the P-Corps. It's here, okay? And parent-to-child transfer can be a gift, but before Prop 19, we'll jump to Prop 19 because you asked the question. Before Prop 19, all parent-to-child transfers were exempt from reassessment, all of them. Now, in order to get Prop 19 on the ballot, CAR went to the legislature because they lost the first time. And then they went back to the well again and went to the Sacramento and said, CAR said, we want to get it on the ballot again. In order to get it on the ballot, we had to give something up. I say we, our state association, had to give something up. So what they gave up was parent-to-child transfer exemption, except parent's principal residence to child who lives in-house as principal residence. That's the only parent-to-child transfer that is now exempt from reassessment. That's why that question is there about, are you going to occupy this property? When do you intend to occupy it? Because the child has to move into the house within 1 year of the transfer and live in it as their principal residence. Okay?
I suppose that was my question earlier, whether when it goes to the
They have up to a year to move in.
But if it's an investment property, then
Reassessed. Imagine, okay, when we get to Prop 19, I'll tell you some ways to get around that. Because there are ways to get around the reassessment on commercial properties. Yes?
Just for instance, we've been in our house a long time. My kids moved out of state. If my wife and I were to pass away, they would inherit our house. they're not gonna move back here. So that house would get reassessed,
Yep. Yeah.
even
Yeah,
if
see-
they kept it as a rental.
Yeah, it will, yeah, see,
Make a
that's,
great rental property, paid off, make great rental,
Yeah.
great rental property, great cash cow probably, but it would get reassessed.
yeah, Prop 19 changed the rules on property taxes. That was a big giveaway. Imagine big commercial buildings like this, if they weren't set up properly and were reassessed when the parents passed away and left it to the kids. There's some ways, I'll tell you about it when we get to Prop 19. But anyway, like I said, the spousal transfers and transfer to trust are kind of the more common ones that we see.
Steve.
Let's see. Question?
Sorry, one more clarifying question, and that will apply, those rules will be per state. So if there are investment properties
Yeah, you
in
gotta-
other
yeah.
states, then those states' rules.
Yeah, you gotta look at each state. We're not talking about federal law here.
Right.
Yeah. Prop 19 is California. Every state taxes property, a lot of states still tax property at fair market value because their values aren't that high. It's not a big deal. Gotta remember, I mean, we're running, median average prices, close to, on homes, close to $2 million, whereas throughout the nation, we're talking about average of about $400,000.
I'm reading a lot of real estate stories about states that are rolling back property taxes.
Yeah.
What?
Yeah, right. All right, moving on. So when a property closes escrow, we prorate the property taxes for as far as closing costs are concerned based on the seller's taxes, not the buyer's new taxes. So that's one thing you really have to make sure your buyers understand is that the taxes that they're gonna pay in escrow, the portion of the tax they're gonna pay in escrow are based on seller's taxes. 6 to 8 months after the sale, they're going to receive what's called a supplemental tax bill for the difference for the taxes based on their new value versus the seller's value. All right? So here's an example of the prorations. When we prorate taxes, it's based on a 30-day month. I know February only has 28 days, but that's how taxes are prorated, okay? The amount per day is calculated based on a 30-day month. So let's, I'll go back to my calendar here. I'm sorry, yeah, that's right. I'm sorry, that's not right. All right, let's keep this real simple. Let's say seller's taxes are $3,600. Why did I use that number?
Divided by 12.
It's divisible by 12 very
It's
nicely.
divisible by 360, yeah, which is $10 a day.
Oh.
Okay. All right. And let's say, what's the date today? 8/11? Is that right?
Yes.
It's been a busy last 3 or 4 days. Let's just say escrow closes today. Now, are taxes due today? Not due till
12/31.
November 1st, correct? Now, generally speaking, if taxes are due within 30 days of the closing, the escrow officer will usually collect taxes from both sides. So if you're closing between October 1st and November 1st, they're usually going to collect from the seller and the buyer and prorate it accordingly. And here, that means after the first of the year, because they're due, anything that closes on or after January 1st, they're going to collect from both sides, because January 1st is within 30 days of February 1st. So that just gives you an idea of what's going to happen in the proration side. Here, if we close August 11th, it's not even October 1st. So the seller's the only one who's going to be charged taxes. Okay? How much is the seller going to be charged? Now here's where it gets kind of interesting, because, and my escrow officer hasn't got back to me, I've discovered recently that not every title company's software programs are programmed the same. For years and years and years, the seller was always charged from July 1st to the day before the close of escrow. What day does the buyer become the owner of the property? August 11th. The seller owns the property through August 10th. The buyer now owns it August 11th. So the seller should be charged from July 1 to August 10. I'm seeing settlement statements that show the close of escrow date, the seller being charged through close of escrow. And I'm saying that's not right. And I think it's she said their software programs, they can use 360 or they can change it to 365. It's interesting because our contract says 30 day, and it should be that date, not that date. So I know it's kind of a petty little thing because it's usually not a whole lot of money, but I'm just letting you know in case unless you end up with a real anal client. I was charged one day too much for it. The reason I know is that I had a seller, he was actually my old next door neighbor. He was the one who influenced me to study real estate principles when I was a senior in high school. And I closed a deal for him, and he didn't want to report it in that year. He wanted to. It was a December. It's a November contract, and it was going to close late December. He didn't want to report it in that year. He wanted to roll it over into the next year. I said, all right, well, January 1st is a holiday, so we can't record on the holiday, so we closed escrow on January 2nd. How many days do you think he was charged for property taxes? 1 day. January 1st. Remember, he had already paid this installment. This installment 1 was paid. He hadn't paid the second installment because it's not due till February 1st. So when we're prorating between the buyer and the seller, if escrow closed on the 2nd, he only had to pay for 1 day. Was the buyer charged? No, the buyer wasn't charged. What happens is the buyer, what's supposed to happen, folks, and we don't do a real good job of this, is that a copy of the seller's tax bill, which you can get just like I showed you off the internet, should be given to the buyer so they know how much their upcoming tax bill is going to be, because the buyer assumes the seller's unpaid property taxes. Okay? Which means, I got the wrong color here. That your buyer, let's say that was your buyer, closed on January 2nd. Your buyer needs to know how much that second installment is. In our case, it's $1,800. Your buyer needs to know that by April 10th, you need to pay $1,800 to the county. But because you only own the property 179 days, okay, you're gonna get a credit for the $10 that the seller paid. You're gonna get a credit for the $10 on your settlement statement because you only owe 179 days. That's how property taxes work. Now, if the seller hasn't paid, if you get within this window here and here, actually here, I'm sorry, I misspoke here. On this one, because taxes are coming due, the buyer will be charged that $17.90 in escrow because we're within 30 days of February 1st. Sorry if I was thinking back the first installment. So in this case, the seller's going to be charged $10, and the buyer's going to be charged $17.90 because escrow is closing within 30 days of February 1st. Understood? Back here, and let's say if we have a closing today, because we're not within this 30-day window, only the seller's going to be charged. And how many days? If you do off of this, 40 days or $400. And the buyer is going to the buyer's going to get a credit on their side for the $400 paid by the seller, and then the buyer needs to know that by December 10th, they need to pay that $1,800 bill, but effectively they're only paying $1,400 because they got a credit for $400. Bless you. You understand that? Questions? It's a matter of, you look at it this way. Are taxes due or not due? If taxes are due, and if they're due within 30 days, then both sides are going to be charged for their share of that installment. If it's early on, only the seller is going to be charged. If the seller's already paid the installment, let's say I sometimes see sellers, pay taxes real early just to get it out of their way. So let's say we closed today. We'll close and forget the calendar. Just go work with me here. Let's say it's 40 days. Okay, which equals $400, and let's say the seller on today escrow closed, and the seller already paid the $1,800. What's going to happen? The buyer is going to be charged $1,400 and is going to pay, because that's their prorated portion. That's what they owe from 8/11 to 12/31. Is that amount? Okay. Remember, the installment for the 6 months is $1,800. Seller owes the first 40 days. Buyer owes the 140 days. You with me? The buyer's charged the $1,400 in escrow, and that $1,400 is credited to the seller because the seller paid the whole bill up front. So you start with, first you go, has the bill been paid or not? Yes, no. If the bill hasn't been paid, when's it due relative to close? Is it within 30 days? If it's within 30 days, both sides get charged for their share. And if not, only the seller's charge. But the buyer needs to be given that tax bill to know how much they're going to owe. I mean, they see it in a preliminary title report, but no one's really telling them, oh, hey, by the way, see that number there? You owe it by December 10th, or you owe it by April 10th. You follow me? You follow me?
Mm-hmm.
What I would say when you represent a buyer, a good idea to make a copy of the property tax bill and give it to your buyer as early as you feel it's necessary to do. I mean, I can make a case for doing it right, just doing it as soon as you start working on the property. Let them see what the taxes are. Full disclosure, here's the tax bill, here's what Here's what makes up your tax bill. Here's what you're paying on. Give them a copy of the bill. There's no contingency in the contract for that. I mean, there's investigation contingency, which it would, if you had an investigation, it would address anything and everything, which would include the property tax bill. I'm saying there's no specific contingency. It says give them the, you know. And then the contract says all supplemental tax bills are handled by the parties outside close of escrow. So sometimes, you know, see if you get, here's where the address is important, so the assessor knows where to send the bills to. Okay? Because sometimes the bills, you know, sometimes if the assessor doesn't have the buyer's new address, the bill may show, you know, and say it's a rental property, the bill may show up at the, you know, at another address. Or if they don't have a new address, a mailing address for the buyer, it could end up being mailed to the seller to a different address, who probably put in a change of address. So the bills can get lost sometimes. All right, that's probably about as clear as mud. Anybody got, don't be afraid to ask questions. That's what we're here for. Everybody understand it? Know how to explain it? Now, the next part of this is the supplemental tax bill. Now, basically what happens with the supplemental tax bill, this kind of tries to talk about what's paid, but it's kind of confusing. This explains supplemental property taxes. Chicago Title still has what shows the proration factor. So what happens with the supplemental property tax bill is you've got a new assessed value based on the typically buyer's purchase price. You've got a previous assessed value for the seller, okay? And you calculate the difference between the buyer's new taxes and the seller's old, and then it's prorated based on what month escrow closed and what's considered the effective date. And the effective date is the first of the month after the month that escrow closed. So an escrow closing in August has an effective date of September 1st. So here's an example of how the calculation works. It's in your handout. So assume a purchase price of $2 million, and if you use 1.25%, buyer's taxes are $25,000. This assumes a close of escrow of August 29th, the last business day of the month. Since the change of ownership is in August, the effective date for prorating supplemental taxes is September 1st. And if you go off of the chart, proration rate for effective date September 1 is 0.83. So then, you know your factor is 0.83. So then, how much are seller's property taxes? Seller's property taxes are $62.50. This is an example I'm giving you. Okay.
I'm sorry. How did we get the 0.83?
From that chart. Escrow closes in August. The effective date is the first of the month after the close of escrow. Close in August. The effective date is September 1st. So in this example, we've got buyer's new taxes of $25,000. Seller's taxes are $62.50. The difference is $18,750. Now that's for 12 months. That's for a whole year. So the proration factor is 0.83. So you take 0.83 times 18,750. That gives you 562. So that's the buyer's supplemental taxes. Now, just understand, in escrow there was a proration of the 6250. Okay, there was a proration there. So the buyer paid a portion of that 6250 to cover the time period from July 1st to August 29th. Okay, they paid a portion of 6250 because they owned it from July 1st to August 29th. But as of August 29th, the assessed value has gone up. That's where we now have to calculate the supplemental tax amount. Okay, so you've got, they're gonna pay basically 59 days. If you take 6250, divide it by 360 and multiply it times 59, that's what the buyer is gonna pay in escrow if that's the seller's taxes. You do the math here, the buyer's gonna get a supplemental tax bill, and it could come 6 to 8 months after close of escrow. Take a long time sometimes, months. And then they'll typically be able to pay it in 2 installments, 7781, in 2 installments. Now, what I suggest with a first-time buyer is you do this calculation, and there is a sheet in your natural hazard zone disclosure report. There's a supplemental property tax calculator in there. That you just have to plug in the numbers. It sends you to a site that will actually calculate it for you. It's not a very complicated calculation, but you can figure it out. Now, I do this for first-time buyers, and I tell them, here's how you're going to get a bill about 6 to 8 months down the road, and you're going to have to pay this bill in 2 installments, and I calculate for them how much it's going to be. And I tell them, start saving this amount of money per month, so when the bill comes, you have money to pay it. And then I always end the conversation by saying, I'm going to bet you lunch that you're going to forget this conversation. Because they always do. I always know when supplemental tax bills hit the mailboxes because my phone starts ringing. And usually you can feel in their voice that they haven't saved a dime, and they probably don't have no way how they're even going to pay this bill, and they immediately think that they already paid property taxes in escrow. And the first thing I hate to do this because I know sometimes I go, you owe me lunch. Because you forgot the conversation we talked about. The taxes you paid in escrow were only the seller's taxes. They weren't your new taxes. Now, sure as I'm standing here, at some point in your career, you're going to represent a buyer, and you're going to get that phone call. And when you do, you're probably, and if you didn't have this discussion, you're probably going to feel kind of bad that you didn't do it, that you didn't let them know. What's this supplemental tax bill all about? I mean, it's in the contract. I mean, what do you say when you see that line in the contract? You just kind of blow through it? Especially with first-time buyers. People that have bought and sold plenty of property, they know the drill. But the first-time buyer doesn't know. And it's especially critical when you've got somebody who's lived in the home a long time, a seller lived in the home a long time. The other thing to be mindful of is because it takes that 6 to 8 months, sometimes you'll have another sale within that, consider the flip, where you got the original seller, then you got the flipper, and then you got the new owner. So now you're going to have 2 sets of supplemental bills. Gets a little hairy at that one. You're like, oh man, it's like, yeah. Just saying. It's like, don't blame me. It's just the way the way it works. All right. Moving on. Your handout says the homeowner's exemption, $7,000. We have a law that says that a homeowner, somebody's going to live in the home, can make a claim to get a $7,000 exemption on their tax bill. $7,000 at 1.25% is a whopping $87.50. Well, hey, it's a dinner out one night, okay? Well, what happens is your buyer's going to get a postcard from the county assessors. I'm going to ask them, are you going to reside in this home? And if so, check this box and mail this form in. Go back to the outline on those 3 tax bills. Go back to it, those 3 tax bills. Okay. Okay, the one on Overactor, that's me. Do I have a homeowner's exemption on my tax bill?
$79.
See the $7,000 there? See it in the right upper right hand corner? Right. See it? See it there? See it where it has the assessed value? On the right.
Oh, okay.
See the 7,000? Okay, now go to the next bill for Newark. Does it have it?
No.
Go to the next bill for Union City. Does it have it? Nope. This slips through the cracks for a lot of people. I mean, and it's never too late to submit one, but you can't go back. I mean, I've seen people that have owned houses for 15 years, 20 years, they've never had it. And I'm doing the math, it's like, man, you lost out on over $1,500 over all this time. It starts adding up. To some people, $79 is a lot of money. To other people, I know big deal, but keep paying that year over year over year when you don't have to. So here's a little thing you can do. You're looking for something to mail or hand out in your farm. Is talk about the homeowner's exemption and say, have you checked your tax bill lately to see if you are getting the $7,000 exemption? If not, call me. And then get the BOE 266 form and work with them to submit that form. They're going to love you for it. Now, you got to put a buyer in escrow, calendar, depending on what month you close. I say, just calendar 12 months. Just calendar 12 months out. Just to cover a full 12 months, or calendar 6 months and then 12 months, and check their tax bill to see if it has the homeowner's exemption on it. And if it doesn't, go, hey, you didn't apply for the homeowner's exemption. You probably got a card in the mail, you didn't know what it was, and threw it down. Okay?
So this exemption is only for the first time buyer?
No, it's for everybody, but I'm just saying, first time buyers typically don't know about it. It happens when you buy a property.
So you get, yeah.
No, it's for any buyer. It's not a first time buyer.
The thing is, here's the thing,
I'm
so
saying-
buyers,
I said, if you close a buyer, calendar 6 to 12 months out to see if they're getting the homeowner's, if they claim the homeowner's exemption. If not, help them do it. Help them get the, point them to the BOE 266. I'm just telling you, in my BOE, it's written down on your, it's written down in the handout. Like I said, BOE stands for Board of Equalization. The reason I say this is I just showed you 2 out of 3. This is a random 2 out of 3. I see lots of them without it.
Can they go back? I think I missed
No,
it.
you can't go back,
Thank you, exemption.
but you can go forward.
I think it
It's
is
never
from
too
this
late
side.
to do it.
it's called the board of
This one.
exemption, only because they're late from payment, right?
No. Homeowner's exemption means we are, I'm sorry if I wasn't clear.
Yeah.
They are reducing your assessed value by $7,000, therefore saving you $79, or in Fremont, saving you $79 per year in taxes. And that's going to move. It goes up it goes up to 2% every year. It's reducing your assessed value by $7,000, and it's annual every year. So for this last year, I saved $79 by having my assessed value reduced $7,000. Sorry if it wasn't clear.
How often can you do that?
It stays in, as long as you're living in the home, you have it every year, it just continues.
Okay.
Now, once you move out of it, you're supposed to report to them that you no longer live in the home. Nobody does
That's
that.
just for primary residence, right?
Your principal residence, yes, that's what it means, a homeowner. Homeowner means that you're living in the house, which is probably 99 out of 100 of your buyers are buying a home to live in.
Yeah.
Remember, you can't go back, but it's never too late.
So we are not seeing for Union City and Geneva here?
I'm sorry?
So we are not seeing.
Meaning they didn't submit a claim form.
They're not getting
Oh,
it.
They
It's an
didn't,
investment
they didn't
property.
ask the county to give them the exemption. It's not automatic, you have to claim it.
So can you claim it
For investment.
later?
Yeah, you can but you can't go collect for years that you lost. You can claim it at any time.
Okay,
Not prorated.
okay.
You can't go back and claim all the years that you lost out.
That or not?
Okay? No, it'd be interesting to see in the room how many people come back and discover that they don't have it.
Yeah, if we don't, then hey, that's gonna get stuck.
Yeah, you can always submit the form in.
Everyone does it.
All right, moving on. Impound account. So basically, you can have, some loans will require an impound account. Impounds is when you pay your taxes and or insurance monthly as part of your payment. Some loans require impound account. FHA requires impounds. And I don't think the rules have changed. I haven't done an FHA deal in a while, but I'm pretty sure they stay with the property. But there are, on FHA. But again, otherwise it's optional for a borrower. Basically what you're doing is you're setting up your loan payment so that you're gonna pay 1/12 of your taxes and insurance in addition to the principal interest payment in your monthly. Now, I see, for first-time buyers, it's all about how good a saver they are. Are you a good saver or not? If you're a good saver, then put the money aside and invest it and earn interest on the money. If you're not a good saver, set up an impound account. That way it's out of sight, out of mind. You're paying it, your lender's gonna end up paying the bills. The tax bill's gonna go to the lender, the insurance bill's gonna go to the lender, and they're gonna pay it when it comes due, and you don't have to worry about it. That's an individual choice. It's optional. Now for tax impounds, which you have, because of the due dates of tax bills, you have to pay a certain number of months in escrow to fund the impound account so that it has enough money to pay the bills when they come due. So depending on what month you close will indicate how many months of taxes you've got to pay in the impound. Now, I discovered last night when I was preparing that this chart says for an August close that there's 7 months, and where did it go? And there's another, wait a minute, I went wrong way, I'm sorry. Then the previous,
5 months.
this chart here says 8 months.
This one says 5 months. Oh,
No,
closing month is
Yeah.
August. Okay.
August is 7 months.
7 months.
Yeah, this one, and I brought it up to the Terry because this one says August is 8 months. I believe this one is accurate.
Okay.
Okay, this one's actually accurate. But remember, that can amount to a lot of money. Let's take our $2 million house. Hard to believe a first-time buyer would be buying $2 million, but around here, yeah, not. So how much taxes? $25,000. How much is that per month? How much is $25,000 per month?
2,000.
125.
Yeah.
Okay, so what's times 7 months? That's about $15,000. That's a huge amount of extra closing costs to pay. Take it down to a lower price point. first-time buyers just barely getting in, if you say, oh, by the way, you wanna do it, your impound account's gonna cost you, another $5,000, $7,000, that might be a big stretch for them. Particularly, you take the FHA buyer, 3.5% down. You start adding on, it's like, oh, wow, I can't come up with all that money, I'm lucky to get the 3.5. Insurance, you can do one or the other or both. With insurance, basically, you generally gotta pay 2 months up front. What's gonna happen with insurance is you're gonna pay the first year premium, and then you wanna impound insurance for the next year. You're gonna typically pay 2 months up front, and then you're gonna pay monthly. I've seen sometimes it's 3 months. And then when the insurance bill comes out each year, the lender's gonna pay the bill. Make sense? Mello-Roos, we kind of talked about. Mello-Roos is when you've got counties, and you can read all this later. I'm just gonna give you a Reader's Digest version. When you've got less affluent counties that don't have big property tax bases, they don't have money to build, for infrastructure, for parks, for schools, for fire stations, and things like that. A developer comes in and says, hey, we want to develop these 50 acres and we want to build houses, and they say, all right, we'll approve your development, you can build all these homes, but we want you to create a Mello-Roos district to collect money to help cover the building of parks, schools, fire department, whatever it is we may need out there, okay? And that's very, very, becoming more and more common for Mello-Roos. You have a lot of it in Tracy, you have it in, Mountain House, and it's on the tax bill, so, if if a listing, as a listing agent, you're gonna list a property and you don't know whether it has Mello-Roos, and your sellers maybe doesn't really pay attention to their tax bill, you look at the tax bill and it'll tell them. Now the PRE will tell you if there's a Mello-Roos as well. It'll be referenced in the preliminary title report. You can have two developments. There's areas in Tracy where you've got one development here has Mello-Roos, and you drive 5 minutes over here next door and it doesn't have Mello-Roos. So don't assume that they all have it. Some do, some don't. Now the Mello-Roos contracts, the schedules can be, the law says they can be up to 40 years long. Most that I see run about 20 to 25 years, and then they're done. They're not infinity, okay?
And basically, the philosophy behind Mello-Roos is, you've got an existing community, homeowners are already paying property taxes, and then you're gonna build a new community that's still part of that community. Why do they need to finance your new stuff?
Right.
So you get a special tax,
It's just the people.
so the new buyers
It's
finance
just
their
the
new
people in
stuff.
that community that are paying for, you take like, when they started Mountain House, there was nothing out there at all. Well, what's the first thing you need when you build all these houses?
Roads.
A fire department. Okay? So the Mello-Roos helped build the fire department. That was the first thing to be built there. Because they're out in the middle of nowhere. And then slowly but surely they start adding on all the other, schools and parks and all the other stuff. Yeah. All right, Prop 19. Okay, we kind of we touched on it already. Like I said, the only parent-to-child exception from reassessment under Prop 19 is parents' principal residence to child living in as principal residence within a year. That's the only one. What are the workarounds to that reassessment? The most common are the owner can set up an S corporation. They can set up a C corporation. They can set up an S corporation. What I'm seeing more and more are what are called family LLCs. So in other words, the title is taken in the name of a LLC, a limited liability company. But within that LLC, the family members are members of the LLC. Prop 13 only reassesses when there's a change of ownership. As long as title remains in the LLC, there can be parents dying off, there's no change of ownership. It's still in the LLC. Okay? That's what our landlord has. Imagine what would happen with Prop 19. If they didn't plan ahead, imagine what their taxes would have gone up. They bought this building back from General Motors around That's a long time ago, 20 years ago, and a long time ago. So imagine how much their taxes would have gone up if this was reassessed at fair market value. Our rents would have gone through the roof. Now, there is a trust, there are special trusts that can be created also to provide for that, okay? So you have, but that, again, that's a trust that has to remain as, it's basically, it's an irrevocable trust that remains as such. Irrevocable trusts are okay for very wealthy people who have to do major tax planning, okay? For most of this, irrevocable trusts, that you need some flexibility. You need to be able to amend your trust from time to time. Change your trustee, change your beneficiary, things like that. Okay, irrevocable trusts are not meant for most people that don't have, if you don't have estate planning consequences or own a lot of property, irrevocable trust is usually not the way to go. You can go with a revocable living trust, okay? Dean's first.
So, in terms of the family LLC, the kids, if they are part of the family LLC, do they need to be adults, or can they be any age?
You can hold, you can hold as a minor, you can have a custodial interest.
Okay, so they can be, they don't need to be
Yeah.
quote unquote adults to be in.
You would hold it as in a custodial account.
Right. Because again, I was asking more from the investment property
Right.
standpoint, and then you said it could be a S corp. What about a C corp?
It could be, if you want to go to all the formality of a C corporation, you could go C corp too.
Okay.
See, S corps are easier and simpler because they're a pass-through entity. You don't, see with a C corp, you have two levels of taxation. C corp is, your big companies are what we call C corporations. You have all these shareholders. The corporation pays all their taxes on their income, and then dividends flow to the shareholders, and the shareholders pay dividends on their stock. In an S corporation, all of the S corp does not pay taxes. It pays $800 to the Sacramento Franchise Tax Board. That's the annual. That's it. Okay, I have an S corporation, and my wife and I are we are shareholders as trustees of our trust. Now we'll talk on Wednesday. We'll talk about some of the other benefits to having an S corp and some of the other things that you can do and so forth from a tax saving strategy. But right now we're just talking about property taxes. So yeah, there's multiple ways that multiple ways to get around this Prop 19 dilemma. Remember, we're talking about California. Okay, we're not talking about your Hawaii property. We're talking about California. Yeah. Wait, John,
The point being, this has to be done ahead of time.
Yeah,
This can't be done after the transfer of the property. It has to be done ahead of time.
Yeah.
And then it flows on.
Right.
But you can't have mom and dad pass away and then try to do this.
What happened was when Prop 19 came into effect, it opened up a window of time and it said, this is when this is going to go into effect. Well, I immediately blasted my database and said, hey, if you've got property that you want to give to your, now remember, giving property to your child while you're alive is generally not a good thing from a capital gain standpoint because they take on your basis, meaning the cost that you paid for the property. And if they decide to sell the property, they're going to likely have a big capital gains tax. But if they live in it as principal residence, there's going to be an exclusion that they can become eligible for, which we'll talk about later. But generally speaking, it's like anytime you have a client says, I want to give something to my child while I'm alive, it's like time out. We need to analyze your situation here, okay? Because remember I talked earlier about stepped up basis? It's much better for a child to inherit a highly appreciated property because the basis, the value, the cost is determined to determine whether there's a capital gain, gets stepped up to value at date of death. Now you turn around and sell it and there's no gain, it disappears, okay? So going back to what John said, yeah, so that you don't want to, you've got to plan ahead. Prop 19 had a window of opportunity for transfers to be made before the parent-to-child transfer exemption went away other than principal residence. So I blasted my database, and I got all these people coming back to me, yeah, I want to give this, my son's already living in the house, I want to give it to him so the taxes stay low. Because otherwise they're going to get reassessed. I did that for 4 different people, okay? Where I did transfers and got that property into the child's name before Prop 19 went into effect to keep their taxes low. Well, that ship sailed now. That date was back in, was it March of 2021 or whatever. There was a window there from the time it was passed until it was going to go into effect to do that. Now that it's happened, yeah, you've got to figure out, you've got to set up an LLC or a special irrevocable trust or an S corp, or you got to do some other transfer that is solely made by the current owners. Doesn't bring in new you're creating it, but you can see once you've got the entity created, you can change who's in the entity. Does that make sense? You can change the shareholders. In fact, Avi, you don't necessarily need to have you don't necessarily have to have them all in the beginning, the kids in the beginning. You can always bring them in later.
But
You can have a resolution, and so you can change who are members of an LLC. You can change who are shareholders. The entity remains the same. See, the whole idea is you don't want to trigger a change of ownership, and you don't want to trigger reassessment.
It has to be before that, right? The owner extends.
No, you've got to get it into entity so that whatever happens going forward,
Yeah,
doesn't
so-
matter what happens after that.
So we cannot have this LLC later, once it's done, like the first.
What do you mean later? What I'm saying is, if you have highly appreciated property that's not a principal residence that you want your child to inherit and not be subject to reassessment, while you're alive, you want to set up one of these entities. Okay? And then once it's done, you can change who are members you can even have your trust be the member of the LLC.
Okay, so let's say I bought a house, okay? Right now it's in my name, and I want to change it to LLC. So can I do it or not?
Yes, you can
We can do it anytime.
transfer anything to an LLC.
Does it affect
Any
on the
real
taxes?
property. No, it's because
No
it's the
change.
same owner.
Okay,
Because the ownership hasn't changed.
okay,
Yeah.
thank you.
See, that transfer is not a parent to child transfer. It's a parent to an LLC
Okay.
that the parent is the member of.
It's the same thing as if you're creating a trust, and now it's
Yeah.
the trust that's owning it.
But,
instead of-
yeah, but remember, it doesn't work with a revocable living trust, which most of us have. Okay, it doesn't work that way. You've got to have a special trust that deals with ownership differently. Okay, a revocable living trust doesn't accomplish that what we're talking about
Oh,
when it's not principal residence.
They have to pay $800 per year.
Yes, every year you owe, the S corp, I have to write an $800 check every year to the franchise tax board. That's for an LLC or an S corp, yeah. That's the extent of your taxes. They're what we call a pass-through entity. Everything passes through to the shareholders and or to the LLC members.
You can have multiple properties in that LLC.
Well,
which
I'm glad
generally-
you asked that
Yeah.
question. Real quick, what's the purpose of an LLC? The purpose of an LLC is to limit your liability to the amount of money that you invested into the property. If you have an LLC are you listening, Abby? If you have an LLC with one LLC with multiple properties, all of the cash that you invested into all the properties is accessible in the event of a lawsuit. So what's the workaround?
Multiple LLCs.
One LLC for each property.
Oh, okay.
And typically, when you see an LLC, it's called 123 Main Street LLC.
Yeah.
That means they're set up one per property, because now you've limited your exposure to just that property.
Expensive.
Now, there's more costs up front,
Pros and cons.
but you have better liability protection.
That's just what I.
And that is not a change of ownership. Corporation, a trust, an LLC, none of those transfers are changes of ownership.
He does it every year.
Business
How about the trust, the living trust and how you affect what the LLC? Living trust.
Well, the LLC is a separate document. You can be a member of your LLC as a trustee of your trust.
Yeah, if
Just like my wife and I are the shareholders of our S corporation as trustees of our trust.
can change
So
the
if we
member.
go past that corporation, those shares in that corporation pass under the trust.
How about living trust is how this affect what the LLC? If we don't,
Well, no, you don't, no, you create an LLC and you make, the members of the LLC are the trustees of the trust.
oh, okay, so they go automatically the party,
You
the
yeah,
member.
you have your trust up here, and that can handle any different properties.
How about the assessed property taxes for the
Okay,
living trust?
transfers, as long as it's the same person's owning, there's no, it's not a change of ownership. You got the same people here, same people here, as long as they match up, that's not a change of ownership. Yeah,
Will my lender stop it?
I'm sorry?
If I change the ownership from my name to
Okay.
my LLC?
What you need to do, yeah, what you need to do is you need to, good question. Most loans have a due on sale clause. You do need to contact your lender to get approval for them, for the transfer. I have not yet ever heard or had personally any situation where a lender called a loan due because it was a transfer by the borrower to an entity set up. I just did some, did it for an LLC, a couple LLCs a few months ago. And in both cases, I had the borrower call the lender says, no problem. Transfers to trust, no problem. Now, transfers to trust, call your insurance company. Make sure you let them know that you've transferred title from you as individuals to as trustees of your trust. Because down south, the insurance companies were kind of making innuendos like they were going to try to play hardball on all these transfers to trust that hadn't been reported to them. They didn't do it, but you should let them know.
Last
All right.
So the LLC has to be in California, or it could be anywhere, Utah LLC?
I couldn't answer that question for you. That's beyond the scope of this.
I have a question, Steve. So for each LLC,
You can have corporations and LLCs in different states if you want. Most people stay within their state.
you know how you were saying there's a workaround for every property you would do a new LLC to limit liability? You would still have to pay $800 to the franchise tax board for every.
The tax-paying entity, if you have each LLC would have to file its own tax bill and pay $800, yeah. That's not a big cost. That's not gonna be a deal breaker for most people. And I don't worry about spending $800 a year when I look at all the savings that I'm getting in taxes.
Irrespective of the price of the house, which is covered by that LLC, it's 800 standardized across.
I'm sorry. The $800 is a income tax bill that you pay for that entity to pay rather than filing an income tax return. It has nothing to do with property taxes and all of that.
For the entity.
See, it's a pass-through they're pass-through entities. So the S Corp files a return, a federal return, a state return, but pays no federal income tax. It passes through you get K-1s to the shareholders. And in the state, you have to file a return and you have to send $800 with the tax return to the state.
Got it.
But you don't pay, but it pays no taxes. Okay, the other part of Prop 19 is it changed the rules for people over 55 buying a replacement property. Under the old Prop 19, it applied within your county, or it applied in about 10 other counties throughout the state. And you can only do it one time. Now you can utilize the transfer of the assessed value up to 3 times, and you can do it anywhere in the state. And the way it works is, if you buy a property equal or lesser in value to what you sold, if you're over 55, you buy a property equal or lesser to what you sold, and and it's your principal residence, you can transfer your current assessed value to that new property, so your taxes don't go up. Okay, and that's huge for a lot of people. I mean, you can see my bill there. I mean, what I'm paying now, if I sold my property, regardless of what I sell it for, if I buy something for no more than what my assessed value is now, my taxes will remain where they are.
Okay.
Okay. Now you have there's another provision where if you you have to look at if you buy something for more expensive than what you sell the property for. So you have your assessed value and then you sell it. You can, and if you buy something equal or less than what you sold it for, you can still get to keep that low assessed value. If you buy something higher, that difference will get added to your assessed value. So say you sold for $2 million and you bought something for $2.5 million. Say I sold my house and I bought something for $2 million. Say I sold it for $2 million and bought something for $2.5. The $500,000 would get added to my $700 or whatever it is. Okay, it wouldn't be 1.25% of 2.5 of the $2.5 million. Okay, you understand? So you either and equal or lesser value. If you sell first and then buy, that equal actually means 105% for the first year. So if you sold it, say, for $2 million, you could go up to 105% of $2 million on the purchase and still keep it. If you wait a year, you can go up 10%. They never talked about that part. Stayed. They never talked about that law, but you still have that 5 and 10% increment up in year 1 and year 2. Any questions on that? Let's see here. I want to. Yeah, okay, we'll talk about that when we get to 1031 changes. Any questions? The thing about Prop 19 is, and this is the summary where I was talking about here. This is where it talks about the 100. If you buy first, it's 100%, and 105, 110, for year 1 and year 2. That remained the same, but you can do it 3 times, not just once. And that also applies if you're disabled or a fire victim. In fact, fire victims aren't even limited to the 3 times. If you really have bad luck, you could keep going more than 3 times. This is the form when you're going to do that transfer. You don't file for it. Here's what happens when you, if you buy a property first, you're going to pay full boat on the taxes until you finally sell. You can buy first and then sell, or sell and buy. You can do either order. But if you buy first, you're going to pay full boat on the taxes until you apply for the transfer, and then you'll get the lower value going forward, but you will still pay the higher one during the first year or 2 before you sell. And so basically, this is a form that once you've closed on both properties, then you send this form with all the information on the replacement and all the information on the original. And then once they get that and approve it, then your low assessed value gets transferred to the new.
So since you said you could buy first, and you have 2 years.
You got 2 years.
So technically you can buy at 53.
Yeah, you can start early. Yeah, good question. Yeah, you could start at 53.
So next year I can buy.
Yeah, you can start at 50. Yeah, you can buy at 53 and then close at 55. Yeah, and you've got to do it. It's got to be 2 years within the purchase, either the sale and the purchase, or the purchase and sale. You've got up to 2 years to do it. Transfer taxes. Okay, is everyone familiar with the customary practices guide? Has everyone seen a copy of it, work with it, knows what's in it? Basically, it's what tells you what's customary by county in California. I say customary, not required. It's still negotiable, but it's customary. It tells us who pays escrow, who pays title. Alameda County is what we call a buyer pay county. Santa Clara County is a seller pay county, as far as escrow and title is concerned. All counties have a county transfer tax of $1.10 per thousand based on the purchase price. Get out your calculator. I
Oh,
don't trust
these
you.
values.
What value?
I mean, like, who will pay?
No, that's just the custom.
Never change.
Customs never change. It's how we generally do things, but it is still negotiable. $2 million purchase price. Transfer tax $1.10 per thousand. How much is the transfer tax?
2,200 over on here.
What did you say?
Why so?
$2,200. Are you all getting $2,200? $1.10 per thousand. There's a couple different ways you can do it in the calculator. Drop the first 3 zeros times $1.10. All right, moving on. You have some cities have a city transfer tax. And I know the print's kind of small even on the what you've got here. We don't have any. Tri-City doesn't have any city transfer taxes, and some of them got tweaked. You know, Hayward used to be I think it was $4.40 or $4.50 for a long time, and they bumped theirs up to $8.50 per thousand. Now city transfer taxes are typically split 50-50 between buyer and seller. Oakland can get really steep. In Oakland, you can have a $2 million house up to $5 million, and it's $17.50 per thousand. That's a lot of money. Even on a run-of-the-mill 300 to 2 million, it's $15 a thousand. So do the math. Let's just say you're looking at an Oakland house for $1 million. City transfer tax is $15,000. Split 50-50, that means your buyer's looking at $7,500 in closing costs, over and above what's normally only 1 to 1.5% of the purchase price. Be careful with first-time buyers. You get into these cities with city transfer tax, you're throwing a lot more money into their closing costs.
50%, yeah.
Questions? I mean, you should have this chart. I mean, I have them everywhere because when you're gonna write an offer, man, I still look at this chart. Even when I get outside of Alameda County, I'm looking at the chart. You know, do they have a city transfer or not? You know, what's customary? When you get outside your where you normally do business, you always want to know. And I've seen we got a lot of Santa Clara County agents writing deals in Fremont, and they try to run a fast one on you. So when you're listing agents, pay close attention to page 2 of the offer as to who's paying title and escrow, because they routinely are programmed to check seller, because Santa Clara is a seller pay county. And when I see it, I don't know if they're just doing it routinely or if they're trying to pull a fast one on me. But so don't get burned by that, because you could be, depending on your price, you could be talking about $2,000, $3,000, $4,000 in costs that your seller could end up paying on an Alameda County property when they shouldn't have. You want to counter it out, counter it back. Does everyone understand what I'm talking about? Yeah, just watch that when you're be very careful when you're reviewing offers, particularly from Santa Clara County. All right, I think this is a good time to stop because it is 12 o'clock. We will move on again on Wednesday. There's going to be a lot of good stuff on Wednesday. We're going to talk about capital gains taxes. We're going to talk about 1031 exchanges, and then I'll get into I'm going to get into some details with you, not only about itemized deductions, but your own personal income tax returns and what you should be keeping track of for deductions. And then we'll talk about some of the different entities and ways to save money on taxes. And we're going to end with a fun little thing talking about hiring your children to work in your business and set up a Roth IRA for them. Okay. Any questions? I've got 3 more minutes till 12:05. But I don't want to start the next topic. Anybody have any questions at all? There's no dumb question. All right, you're all free to go.
ऐसे मैं अपनी बेटी को बोलती अभी वो मुझे बोलती रोल रिवर्सल